Hello everyone. I'm so glad you're here for another fun session in accounting. Today, we're exploring real-world examples based on a local business called Emad Cake, a charming bakery with financial transactions as rich and layered as its desserts. This video is about improving your transaction recording, so make sure you have your notebook handy. Here's how it will go. When a question pops up on the screen, just pause the video, try solving it on your own, and then hit play to see the answer and the reasoning behind it. So let's jump in and start our accounting journey with Emad Cake. And now it's your turn. Let's tackle the first review question together and see how this plays out in a real-world example from Emad Cake. Write a brief explanation of the transaction that might appear in the General Journal. First, Chef Emad bought equipment worth $8,000. To pay for this, he used $2,000 in cash and the remaining $6,000 was recorded as accounts payable to Salman Badi. This means Chef Emad has a short-term liability to pay back Salman. The explanation is equipment was purchased with 25% paid in cash and the remaining balance on account. Next, Chef Emad paid $2,000 in cash towards this debt. This payment reduces both his cash and accounts payable by the same amount, reflecting a lower liability. So the explanation is partial settlement of accounts payable. After this, Chef Emad still had $4,000 left in accounts payable. Instead of paying this off immediately, he decided to convert it into a formal notes payable. This means he now has a structured loan agreement with Salman Badi for the remaining amount. The explanation is a notes payable is settled by paying off an account payable. These transactions initially don't affect Emad's capital directly. However, they do change the structure of his liabilities. By converting the remaining accounts payable into notes payable, he creates a longer-term liability which can be more manageable for cash flow. To make this clear, let's look at these three key points. Chef Emad efficiently managed his initial purchase by splitting the payment between cash and credit, then strategically converting part of his debt into a formal loan to better manage his cash flow and extend repayment terms. It's important to note that if Chef Emad has to pay interest on this note payable, those interest payments will be considered an expense and will reduce his net income in future accounting periods. And now, let's move on to the next scenario. Chef Emad is reviewing the initial investment and preparing to record the opening entry in the General Journal. The business started operations with an initial investment that included cash, supplies, equipment, and furniture. Now let's see how this information is recorded in the General Journal for Emad Cake. And now, let's move on to the next scenario. Chef Emad is reviewing the initial investment and preparing to record the opening entry in the General Journal. The business started operations with an initial investment that included cash, supplies, equipment, and furniture. Now let's see how this information is recorded in the General Journal for Emad Cake. Let's go through the answer together. In this example, we will record the Emad Cake's investment in the business. First, we will debit the following assets: cash, supplies, equipment, and furniture, reflecting the amounts of the investment. Cash is debited by $5,000, supplies are debited by $10,000, equipment is debited by $12,500, and furniture is debited by $7,000. Each debit indicates an increase in these assets due to the owner's contribution. Next, we will credit Imad's capital account for the total amount of $34,500. This credit represents the owner's equity in the business, essentially reflecting the total value of what Emad has invested. Now that we've covered the basic investment entry, let's look at a slightly different scenario. If Emad Cake owed a balance on the equipment of $3,500, what would be the opening entry then? In this situation, we debit equipment for the full $12,500 as total cost. Then we credit accounts payable for $3,500 balance owed, representing the liability. Finally, we credit Emad's capital for $31,000, which reflects his personal investment after accounting for the debt. Now, let's look at another scenario that builds on Emad Cafe's success and shows how journal entries can reflect improvements and expansions. The parent company decided to expand Emad Cafe, transforming the outdoor space into a charming haven for guests. Elegant tables were arranged to offer a perfect view of the surroundings. At the same time, the garden was thoughtfully enhanced, creating a serene atmosphere where clients could relax, enjoy the beauty of the outdoors, and savor their coffee and cake. So how would we record the journal entries for these improvements and the addition of the elegant seating arrangements? And now, let's walk through this step by step together. In the first transaction, Emad invested $12,000 in cash to expand the business. Here, we're recording the owner's investment. So we debit cash to show the business received $12,000 and we credit owner's equity to recognize Emad's contribution. In the second transaction, Emad paid $7,000 for tables and chairs. In this case, Emad Cafe purchased new tables and chairs for $7,000. So we debit furniture and fixtures because it's an asset the business now owns, and we credit cash to record the payment. In transaction 3, Emad bought equipment worth $4,000 on account. This transaction shows the cafe buying equipment on credit. So we debit equipment to record the asset and credit accounts payable because the amount is still owed. In transaction 4, Emad received $15,000 in sales income. Here, the cafe earned $15,000 from sales. We debit cash to show the money received and credit sales revenue to record the income. And finally, Emad paid 1/5 of the amount owed on the equipment. So we debit accounts payable to reduce the liability and credit cash to show the payment. Question 4. Before we review the events, let's take a moment to clarify the purpose of this question. The goal is to evaluate your ability to accurately record and differentiate between billing, also known as revenue recognition, and cash collection. We want to ensure that you understand how to prepare the correct journal entries using the accrual basis of accounting. Let's begin by reviewing the first event presented in question 4. Emad Cake has provided cake and catering services to its clients and issued invoices totaling $4,500. The second event indicates that Emad Cake has collected $1,500 in payments from clients who had previously been billed. So what does this mean in accounting terms? Emad has earned revenue by providing these services, which results in an increase of $4,500 to the company's accounts receivable. This reflects the amount owed by clients. Simultaneously, the revenue account is increased by $4,500 to record the income earned from delivering the services. It's important to note that no cash has been received at this stage. This transaction represents a promise of future payment rather than an immediate inflow of funds. In the second event, Emad Cake receives $1,500 from clients who had previously been billed. This payment increases the cash account by $1,500 and reduces accounts receivable by the same amount. Essentially, the transaction records the conversion of amounts owed into cash on hand. Now you might be asking yourself an important question. Why don't we credit sales revenue again when we collect payment from clients who were already billed? Well, here's the key. When the services were originally provided and the clients were billed, we already recognized the revenue at that point. That's when we credited the sales revenue account and debited accounts receivable to reflect what the clients owe us. So, when the cash is finally received, there is no need to touch the revenue account again. Instead, we simply shift the amount from accounts receivable to cash. The income was already recorded, it doesn't get recorded twice. This isn't just an example, it's a reflection of a fundamental accounting rule. What we're applying here is the accrual basis of accounting. Let's recall the accrual basis and cash basis that we covered in Lesson 2 Financial Statements Part 1. The accrual basis recognizes revenues and expenses when they are earned or incurred, even if the cash is received or paid in the future. This method matches revenues with their related expenses, providing a more accurate picture of the financial health. On the other hand, cash basis accounting records revenues only when cash is received and expenses are recorded only when cash is paid. This approach can mispresent a company's financial position by ignoring receivables and payables. I hope you enjoyed my session on review questions for recording transactions. I appreciate you all for listening. Goodbye.